Hello and welcome everyone. Today we're going to do a Q&A for anything and everything tax. It is presented by myself, Aidan Corcoran, who is a personal tax senior at GoSimpleTax. I've been here almost 2 years now, with over 10 years of tax knowledge, being in the accountancy sector for 10 years. And I've joined GoSimpleTax to present webinars, help out on support, and also develop new services. I know that a couple of questions have come from people that I have done a tax review for. If you aren't too sure on what a tax review is, I'll go into that in a little bit more detail later. But what we're going to do to begin with is just say that I have tried to answer as many questions as possible. Obviously, we are limited time. So if your question hasn't been answered here, perhaps drop your email address in the Q&A section, and we can answer that direct. So without further ado, first question that we received was, I am a sole trader working from home. What home office expenses can I claim? What motor expenses can I claim? And my wife is also an employee. So straight away with this one, we're going to look at simplified expenses, actual expenses, and then just touch on payroll towards the end. So first of all, we're going to look at use of home. As a self-employed individual working from home, you basically have to use what we call a flat rate basis. You would look at the number of hours you use your home for business per month, and then you get a relevant flat rate for each month. So if you work from home for 25 to 50 hours per month, then you get £10 per month. I'll stop saying per month now because you'll probably get bored otherwise. 51 to 100 hours, and you'd get £18. And then 101 hours and more, you get £26 per month. So altogether, what you do is look on a month-by-month basis and allocate, obviously, the correct flat rate per the business hours. Sticking on the simplified expenses, for motor expenses, you will have the mileage allowance. You can't claim any other expenditure for your car or your van. What you would do though is track your mileage, in particular your business mileage, and you would simply, for the first 10,000 miles, you can claim each mile at 45 pence, and then 25 pence thereafter. So it's minimal record keeping. You just need to keep receipts for the equivalent of the claim. But other than that, you also, and you also need to keep a mileage log, like I said, for business and personal use. But you would just be claiming the business mileage there for the simplified expense for travel. Moving on to something that's a little bit more complicated is the actual expenditure. So if you decide that you don't want to use the flat rate expenses or simplified expenses, then you would look at your costs for things in your home. So the things that you usually would claim would be heating, electricity, council tax, mortgage interest or rent, internet and telephone. And what you would literally do is add all those up for your accounting period, and then you would divide them by the number of rooms you use for business in your house. So for example, if you lived in a 2-bed, 2 up, 2 down, then you would look there and say, right, okay, there's potentially 4 rooms that I can work in, which would be the 2 bedrooms, the kitchen, or the living room downstairs. Therefore, whatever the total is, you would divide by 4 if you use 1 room for business, and then you would then, again, times by a percentage of the time you use that room for business. If you 100% allocate a room for business, then there can be complications with capital gains tax. So I wouldn't advise on that. If you use it 95% for business, that's fine. You can still keep PPR at 100% for your home. Something to definitely either get advice on or read about prior to making claims. On the other side, with the motor and travel expenses, you can claim the following expenditure. So you can claim your vehicle insurance, your repairs, services, road tax, and fuel. What you would do is gather all them in the expenses from the accounting period. You would have tracked your mileage, obviously, for total mileage and then business mileage, worked out the percentage that you use for business, and then times the total expenditure times by the business use percentage. This will obviously give you then your business element, which will be allowable in your accounts. If you use actual expenditure for car, then you may possibly also be able to claim capital allowances on the vehicle itself. That would be introducing it into the company, or your business, should I say, and then depending on the CO2 emissions, you would put it into a specific category, whether it's main rate or special rate, and then you would write down the allowance at either 18% or 6%, depending on the CO2 emissions. If your CO2 emissions are less than 50, then you would go into the main pool, and if they are more than 50, then you would go into the special rate pool, which is a lower percentage. And then just quickly touching there, if your wife is also an employee, I assume you do a payroll for her. If not, then I would assume that she invoices you for the amounts each month, and then it will be an allowable expense. You can't just simply say, my wife is an employee, I pay her £8,000 a year, but she doesn't declare it and you don't put it through a payroll, because there will be NI contributions potentially, and potentially tax depending on her other situation. So if you do have your wife on payroll, then that's fine. Otherwise, I would suggest getting somewhat of advice to follow up on this. Just going to touch on that as I'm going along. Anything that I'm saying here is not tax advice. It is simply factual. So if there are if there is anybody that's going to look at these answers and then go away and perform the actions that I've said, then it is your own risk, and we do actually recommend getting tax advice on the matter rather than just following what is said on this Q&A, just obviously for liability purposes. So the next question. My wife and I have been a non-resident working in multiple countries around the world for more than 25 years. We're in the process of selling our jointly owned house in London that we owned for 30 years and rented for 29. I understand the difference between I want to understand the difference between the resident and non-resident capital gains tax calculation process. Just as a brief one on this one, as there's so much more information that's needed before you can give an accurate answer. But provided that the property is in the UK, you will pay capital gain tax if you've made a gain, regardless of whether you are a resident or non-resident. Basically, on most, if not all, every double taxation treaty that I've experienced so far, which is more than a couple of handfuls, they've all said that if the immovable property is in the specific contracting state, which in this example would be London, you would always be taxable or taxed in the UK. So yeah, regardless of whether you're resident or not, you will have capital gains to pay on any gain, and because it's a UK property, then you would have to report that within 60 days and pay any tax due within 60 days. So yes, that's the best I can do on that one. If you've got more details, such as if you lived in it for let's say 3 years, then you may have a PPR claim. If you rented it at some point, you may have lettings relief. All in reliefs are not explained in this question. It's more a fact of, again, go away and get some advice, because it is well worth planning things like this, especially with selling properties, which in London, I'm assuming, will be quite a hefty gain, because you can mitigate some tax by either selling some of it to selling some of it, during one tax year, selling some of it the next tax year if that's possible, and then just using annual exemptions from 2 tax years rather than just 1. But yes, I would definitely recommend on getting some tax planning advice from there. Next question. I've just returned to the UK and kept a job abroad. My wage is paid overseas, and I wanted to know how I should proceed on my self-assessment so I can pay the right tax on this. So a few points on this one, if I remember rightly. If you're returning to the UK and you're now a UK resident, you may potentially have a split year treatment claim. I would suggest going online to HMRC or even Google and typing in RDR3, which is basically the statutory residency tests, and you will be have the explanations there of what split year treatment is. If you fall within that, it basically means that during a single tax year, you can split it into two, and prior to coming back to the UK, you would only be taxable on UK-sourced income, and then once you return to the UK, you'll be taxable on worldwide income. So effectively, because you've said that you've returned into the UK, you'll then no doubt become a UK resident. You'll be taxable on worldwide income, and therefore, if you are taxed in both the UK and the overseas place that you've just come back from, then if it's taxed in both, then you will or should be eligible for foreign tax credit relief, FTCR, which basically limits the amount of tax that you can be taxed on in the UK if you've been taxed elsewhere. And that basically is the in-between between the two countries. I would suggest, once again, going on to HMRC and looking at what rates you can claim, because it's different for each country. For example, I believe if you were in Spain and you received interest, it gets taxed in the UK as well. You're limited to 15% claimed on that one. So it's well worth always Google is your friend, especially on HMRC's website, and going and looking into that in more detail. As you've not said the country, I obviously couldn't give any specifics. Apologies. Next question. I am self-employed to an employer. I have a tax code from my previous employer where I worked as a full-time employee. Do I need another tax code and another reference number for self-employed tax payment? So quick one on these. If you're now self-employed, then you should have a SA 103 schedule on your tax return. SA 103 is effectively a self-employed schedule. So you would record your income and expenditure on your tax return, and basically that's what you would do on there. Also, because you have a previous employer, I'm assuming that was during the same tax year, then you would also need to include your P45 details on an SA 102 schedule. Just as a side note, we do get this question quite a lot on support, and the question is, where do I put my tax code? Well, your tax code doesn't go anywhere on your tax return, surprisingly enough. That is just an estimate that is applied to employment income during the year, and is usually wrong, unless you've just got a basic code 1257L, I believe. Then that's just a basic code, and that's if you get the full personal allowance. If it differs to that, then it usually means that you've got either additional reliefs or you've got some expenses coming off there, deductions coming off your tax code. No matter what your tax code is and whether tax has been deducted from your employment, if it's wrong, then whatever your tax return does show is what will be due at the end of the year. No exceptions. Even if HMRC give you too much allowances and you pay no tax throughout the year, you come to complete your self-assessment tax return and you've got a £10,000 liability, you should have noticed that your tax code was wrong, and therefore you are still liable to that £10,000 regardless. So yeah, that's just a quick note on tax codes. Question here. I am a higher rate taxpayer and I've increased payments to my pension for 21-22. I have only received a tax relief at 20%. How is the difference calculated and how can I claim? So in this situation, you basically have, well, two different situations. You would look at the SA 100 and on page TR4, and if you've made personal pension contributions to a private pension, for example, let's say you've got a Scottish Widows pension or a Viva pension outside of your employment, and you've contributed towards it, obviously you input the net figure and it gets grossed up about 20%, then you would include the net figure in box 1 on your TR4 SA 100, and then this would be included in your tax calculation by rating up basically your tax bands. So depending on what the pension contribution was, the tax band would go from 50,270 up to whatever the gross pension amount was. Alternatively, if you have a employer pension contribution, most people do now with auto enrollment, if this is deducted after tax has been paid on your employment salary, then you would include the gross amount in the amount deducted, should I say, in box 3, again on SA 100 TR4. this would basically say that you've done some contributions and you've not received the full tax relief for it. Therefore, it will be uplifted on the tax calculation. That is where you would claim for it on there. Otherwise, you could write to HMRC on an overpayment relief claim and basically say that you've only received basic rate on your pension contributions during the year for a previous year, and then they will adjust the calculation per the numbers that you give, obviously, after checking. So before we just jump onto this question, I'm just going to flick back to the meeting here, and we've got a poll. So the first poll here is, do you use GoSimpleTax? Nice and easy. You've obviously joined GoSimpleTax's webinar today to ask questions and see the answers. So it would be nice if everyone can jump on and choose one of the options. You've either got yes, no, or I'm going to start using GoSimpleTax. So I'll just wait until the vast majority of people have voted, and then we will carry on. So we have 5 people that haven't voted yet, but the numbers seem rather static. So just give you an idea for everybody who's on the webinar, we've got 63% of people are using GoSimpleTax, 22% aren't, and 13% are going to start. Great. Hopefully, after this Q&A session, a few more people will decide that they're going to start using it as well. So those 5 that has voted no, hopefully we can change your minds today. So I'll just flip back to here now. Right, okay. So question now is, my wife and I have not submitted a tax return for some years since we retired. However, we recently downsized and with a spare cash bought a small property in our joint names, which is rented out. Even with this extra income, we do not think we need to exceed our personal allowance. Okay, so not much information given there, but what I've assumed is you have somewhat of a small pension as well. So if your rental income is more than £2,500, you will both need to complete a return. That is your share of the rental income. Obviously, with somewhat of a personal a pension, and if you've got state pension as well, after a couple of years, you might be pushing in towards that basic rate band. So it's definitely best to keep on top of your allowance. And if your rental income exceeds 2,500, then you should definitely complete a tax return. On each tax return, you would include half the income and expenditure, as well as other income that you may have, such as pensions, like I've just mentioned. So, yeah, that's basically that one. Next question, how do I calculate tax on foreign dividends over 2K, and which percentage foreign tax / tax credit or relief do I use for US and Spain on the drop-down menu on self-assessment? So you would actually select the correct country code when including the foreign dividend on the SA106 foreign pages as it exceeds £2,000, and then you would have to calculate the foreign tax credit relief that can be found on HMRC help sheet HS263, which basically gives you the running commentary of how to account for that. Also on there will be a link for a digest of all foreign dividends, whereby you can see what tax rate you can claim on your tax return. When calculating the foreign tax credit relief, I would suggest using the foreign tax credit relief worksheet, which is FTCRWS, and that is quite a complex calculation, to be honest. You would effectively look at your tax return prior to including the dividends. You would then do the same calculation including dividends, and that is the tax due in the UK on that foreign dividend, and you would effectively be able to claim up to the maximum of the tax due on the UK side of things. So let's say, for example, Spain taxed dividends at 25%. They don't, but let's say they do, and then you come to you've included on your tax return, and it's being taxed at 7.5% at the basic rate, or 8.75 next year, then you would be able to claim the difference of 25% minus 7.5% or 8.75%, whichever one. there, and you'll be able to claim the difference as foreign tax credit relief. Moving on, when entering finance costs for property/BTL accounts, for example, mortgage interest payments, how does it work? How/where is it entered, and how do you enter them when including unused finance cost into next year's return? So, looking at this one there, basically, over the last few years, HMRC have taken mortgage interest payments out of the P&L account for landlord properties, buy-to-let properties, and have instead included it as a tax reducer. So you only receive tax relief for mortgage interest payments when the property income is taxable. Let's say you are, or you have, let's say, £2,570 of income, to make it nice and straightforward. In line with a personal allowance, you've got £10,000 of allowance left. Let's say you have £15,000 of profit. £10,000 of that will drop into your personal allowance. There we go, 0%. And then we've got £5,000, which is taxable. If you've got mortgage interest payments of £5,000, then effectively that nets off at a 20% of £5,000 reducer, which will be £1,000, and the tax due on the £5,000 would also be at 20%, being £1,000. So, however, if you had £5,000 of mortgage interest and you only had £12,500, let's say, of profits, then you would have £2,500 spare, which haven't been used because you've not got that property income that's been taxable. That would effectively drop onto the box 48, I believe, on the SA 105, and you can carry that forward towards next year. So if you've got, let's say, £2,500 taxable on next year's tax return, then that carried forward unused finance costs can be then used as a tax reducer against that income. Tax relief for mortgage interest payments is only available at basic rate as well. So if you are a higher rate taxpayer, you are basically limited to basic rate on your mortgage interest payments as a tax reducer going forward. That was one of the criteria when HMRC included it in. They wanted to basically limit the relief available to higher and additional rate taxpayers. There we go. If you have a mortgage interest payments of £5,000 and taxable property profits of £3,000, there would be £2,000 unused finance costs, and therefore these will be carried forward to next year. You would include your mortgage interest payments in box 46 of the current tax year, and then unused, I believe, is in 48, as mentioned before. Next question. I'm on a skilled working visa in the UK, working for VFX Movies. I'm paying around £930 every month as tax on a 1257L tax code, and my NI category is A. Is there a possibility to get an income tax return, as this is a lot of money taken out of my salary every month? So if you've got a tax code, as I mentioned earlier, of 1257L, it's highly unlikely that you'll be paying too much tax, because that is effectively the personal allowance. So you're getting the correct tax-free amount subject to your employment income. I've worked the numbers backwards. Obviously, you've not given me the numbers, but I'm assuming, or I'm estimating, that your salary is approximately 59 to 60k. That means that you would be expected to pay around about £900 to £940 worth of tax each month. If that's correct, then no, you can't get any tax refund because you're not paying too much tax from my calculations. But if your salary is much less than 59k, let's say 40k, and you are getting £930 per month of tax deducted, then you may be overpaying, and I would contact HMRC to query this. Once again, don't have the full information. I've just had to work backwards from the numbers. So if I'm miles out, let me know in the Q&A section if you did answer that question, and perhaps I could email you separately for that. Next question. I have 2 properties that my wife and I let currently. I anticipate retiring in the autumn of 2024, and being inside accommodation, we'll be looking to buy our own house. Our plan is to sell our 2 smaller properties and buy our retirement house with the proceeds. Can I avoid capital gains tax if I sell my houses in separate and following tax years? I would basically advise to get some tax planning advice on that one. You have to take into account the length of time that you've owned the properties, and then whether you've actually lived in the houses at all whilst owning them, as well as I said before, lettings relief as well. All that information would be looked at on a property by property basis, and from there you can calculate your gain what in one tax year, and you can basically look at potentially transferring more of a share to your wife if she's got less income and she's got more available allowances or losses brought forward. It's just a fact finding. It's just a fact finding. What am I trying to say here? Fact finding case by case basis to say, right, okay, have you got any losses brought forward? Have you got? Did you live in the property? So you can look at PPR, etc., etc. And as you're going through all that, you'll basically calculate gain, and you'll then look at what allowances or what other income you've got and what rates they're going to be at, and you would do a whole tax planning exercise. If you sell one on the 5th of April and one on the 6th of April, yes, you'll be using exemptions from 2 different tax years, but I would advise, once again, to get tax planning advice, because there may be other things such as transferring a bigger share to your wife to utilise the lower rates in comparison to what you may be earning, or vice versa. If your wife earns more than you, then she might have more. She might have more income at potentially a higher tax rate, and therefore transferring more of the property to you to utilise the lower rates is good tax planning. So in short, you may not be able to avoid capital gains tax, but you can certainly minimise it with good tax planning. Again, we don't do any tax planning, but if you're struggling to find someone, I'm sure we can put you in touch with the right person. Next question. I've got 2 businesses. One is very easy. Then I started an antique shop on Etsy. I've done the first year return no problem, but now I don't know how to show the fact that I still have items that I bought in that first year and have not yet sold. I've put those costs down once. How do I include them again? And how do you account for stock bought in a previous year? So you've just got effectively a stock adjustment. And it should be shown in this. It's basically opening stock plus purchases less closing stock, and that will give you effectively what stock's been used during the year. That would be an allowable expense because it relates directly to your sales, and therefore you would have what would be the stock used during the year. You would use the closing stock on this year as your opening stock next year, once again, plus purchases made during the year, less the closing stock at the last day of the accounting period, and therefore, once again, you'd have the relevant stock used during the year in relevance to your sales. And that's pretty much it. So rather than accounting for the cost every single time during the year, you would, in your first year, you would have had an opening stock of 0. During the year, you purchased £5,000 worth of stock. You sold half of it, £2,500, and obviously had your uplifting or your markup to make a profit. But your closing stock would be £2,500. So effectively, your stock adjustment for that year would be 0 plus 5,000 minus 2,500 would mean you've got an expense allowable in your accounts of 2,500 in relation to stock. Moving on, you've had a boiler replaced like for like. What's the best way to word the information on your tax return? If you sent your tax return already and you forgot to add some information, what should you do? I've gone on the basis that I wouldn't worry. If you keep your receipt and you document it correctly, that it was like for like, then if HMRC come and knock in within 12 months or longer, if they've got suspicions that you're being a bit dodgy, then you are holding relevant information and relevant records. Provided you can give HMRC this information for the check, then it is sufficient. I wouldn't quite worry about that one, provided that it is like for like and it's not a ridiculous amount spent for what actually isn't like for like. You could have included a box, a comment, sorry, in the box 19, which is basically where you can include any information about returning the white space. But if you forgot that, I wouldn't amend it. I would just simply leave it as it is and keep the receipts safe. Can you quickly run through CGT, the best way to reduce this and how this impacts on your tax return? Again, this will completely depend on assets you're looking to sell and your status of residence and domicile. In short, making use of your annual exemptions and spreading the gains over multiple tax years is the best form of planning. If you have assets in loss-making positions, selling these to reduce the gains may also be an option. So if you've got a couple of assets where you're making a big gain and you've got other assets which are like in a stalemate, basically, where you're not really seeing, let's say, much growth on them, and you reckon that you're probably not going to see much growth on them, then you could sell them on purpose to basically reduce your taxable position. That's obviously down to yourselves and whether you think that that asset may become good or not. But yeah, as always, I would suggest getting tax advice, especially when CGT planning, because there are some nifty tricks like the zero gain, zero loss transfer that you can make between married couples. So utilising more of their lower rates and zero rates, or even losses brought forward in comparison to your own. Next question. Given the dire straits the UK is in following Brexit, if I decide to become a tax resident in Portugal, how will this affect my tax liability to the UK from a property perspective, rental income, and then potential property sales such as CGT? So from a property perspective, rental income and disposal will still be subject to UK tax per double tax treaty. Immovable property, I did mention that a little bit earlier. Yeah, if you have land and property in the UK, usually any income deriving from that will be subject to UK tax regardless. And likewise, when you come to sell, any gains will be subject to tax in the UK as well, CGT. If you're in a position to retire, I believe there are some tax haven, so to say, methods or beneficial schemes, especially in pensions. So basically, if you're looking to retire, this is away from the property perspective, and especially in Portugal, then you can have a look at pensions, and I think you can move either somewhere in Portugal, I'm not too sure where, and join a specific scheme, and I think that you actually get your pension tax-free for, I'm not too sure how many years, but I have seen some people do that on my tax reviews after looking into it. And yeah, it's a specific scheme that when you're looking to retire pension income, because you are looking to live and retire in Portugal, they actually have a deal with the UK whereby there's no tax payable on the pensions, or if it is taxed, then it's taxed at 0% per taxation treaties. Some information on the Enterprise Investment Scheme, EIS, for the small investor. Pretty much any information you want in regards to EIS and income tax relief, then look at HMRC's help sheet 341. In short, income tax relief at 30% up to £1 million per investment of an EIS company. It can be doubled up to 2 million, provided that anything above that £1 million investment is invested into a KIC, which is a knowledge intensive company. So that's that one. And then HMRC help sheet 297, capital gains tax and EIS. There's no CGT charge on any gains of EIS shares disposed after the minimum holding period of 3 years, provided that income tax relief was never withdrawn and was definitely given. If there was some withdrawal, then I believe that there's a section of shares that will be subject to tax. But provided that you did receive the income tax relief, held it for more than 3 years, sorry, and the relief wasn't withdrawn, then no CGT charged. There's clawback of relief if gifted or sold before the holding for the 3-year minimum holding period. So if you gifted or sold them between purchase date and year 3, then there is a clawback depending on the time period that they were held for. And just a side note, provided that you meet the criteria for business asset disposal relief, it is available, which is at 10%, up to 10 million, I believe. Sorry, next question. Can landlords claim the digital annual fee as an expense? So no, this is just a nice short answer. Funnily enough, HMRC don't deem the expense of your tax return to be wholly and exclusively for the purpose of the business, and therefore it is not allowable. If you were to have an accountant, then those fees would be allowable, as they would 9 times out of 10 provide you with somewhat of a property account, and that is what they would argue is what the cost is for. The actual calculation of your tax liability is not an allowable expense, unfortunately. Next one. I'm a UK citizen resident in Portugal for the past 5 years. Our UK property was sold in February and is liable to capital gains tax for any profit during the rental period. Any gain is small and likely to fall within the CG exemption. What forms do I need to complete and what documentation do I need to provide to HMRC? So there's a couple of points on this one. Rental income that you received whilst owning the property, so from April to February. If you receive rental income, then you would have to report that income on a tax return. Assuming that it's February 2022, then you would have until January 23 to submit your 21-22 tax return, detail any income and expenses on there. Also, your gain, it would have had to be reported on your tax return as well. However, because it was April 22, then you should have completed a capital gains tax return, and then within 36 days of sale, and you should have also paid any tax due, if any. As you said, it was within the CG exemption, then you wouldn't have anything to pay, but you would still need to complete a tax return for your capital gain within the time limit. If you haven't done that yet, I would suggest looking at that ASAP. Do you have a contact who can advise about CGT if I'm resident in France with property and thinking to sell in the UK? Please get in touch with support and we can provide HMRC documentation that is relevant to sale, which is what I've reiterated a few times. As it's a UK property, it's very likely that you will have a UK liability if you are going to make a gain on the property. And you'll also obviously have your capital gains tax return reportable within 60 days, as well as any tax payable within 60 days as well. We can't provide any advice ourselves, but we could put you in contact with someone who can, if necessary, if those HMRC documentation don't fit the bill. Question. I have both employment revenues, I have both employment reviews and self-employment revenues. On my self-employment revenues, I'm carrying forward a cumulative loss of 7,272 as of the end of tax year 2021. Is it possible to use these tax losses to offset some of the tax paid on the employment income? If yes, how can I do that in the 21-22 return? So, answer no. But in the year that you make a loss, you can offset the losses against net income from other sources of income in that year, but only in that year. You can't carry it forward and then offset it. So if you made somewhat of a loss in 2021, then you've got until the 31st of January to go back and amend that tax return. So let's say you made £3,000 a loss in 2021. You can go back onto that tax return, submit a Section 64 loss relief claim on that return, basically offset that £3,000 loss against your employment income during the year, and at that point you would obviously receive, depending on your level of tax, 20% or 4% tax due on your employment income. If you carry it forward, which in your question you have, then unfortunately you can only carry it forward against the same trade. So in 21-22, if you made a loss again, that will just accumulate and accumulate. If you make any profits in 21-22, then you can offset somewhat of the loss against that trading profit. If you, let's say, have £2,272 worth of profit in 21-22, then offset the losses and you'll have £5,000 to carry forward. And that's pretty much what I've said there. You can't use losses that have been carried forward from a previous tax year against net income in that future year. You can only use it in that direct year that you've made the loss. So I would suggest doing that ASAP, because after January you won't be able to go back and amend 21-22 for that purpose. You've got until 12 months after the original deadline for that to happen and make that claim. Assuming the loss was made in 2021, you would need to account for this by 31st of January 23 and amend your return, like I've just said. Hopefully that explains that one. Hopefully you've got some loss from last year, which you have also got employment income from last year that you can offset against it. If not, then unfortunately you just have to carry it forward. Next question. I have one property which I have put in the trust for my grandson and granddaughter. No mortgage or loan. Will I be able to use your program to do the trust account and send it to HMRC? At the moment, I'm using an accountant, which is very expensive. Unfortunately not. You will not be able to complete your trust return with GoSimpleTax. GoSimpleTax only has SA 100s and SA 800s available, which is individual tax returns and partnership tax returns. If they have any distributions from the trust, you will be able to complete their personal tax returns with us, though, and usually that I would assume that would generate a refund for the grandson and granddaughter, provided that they've not got other income or their other income sources are low. So unfortunately, no trust return, but you can complete their personal tax returns if they have to do one from the trust income. Next question. My son has just started setting up his own business, selling his art. He also works as a self-employed carer and also has another employed income as a teacher. He has registered as self-employed for HMRC. What should he do now? Well, is the business a limited company or another self-employed business? Assuming it's a self-employed business, as that's what we like at GoSimpleTax, then you would need to complete an SA 103 schedule for his art, which is a self-employed page. You would need to complete a second SA 103 schedule for his carer income. So that would be two separate self-employed schedules. And then on the SA 102, you would include his employment income, I'm assuming, from the P60 that he would receive. So that tax return would be quite bulky, as you would have three separate schedules for his three different sources of income. Assuming that this is year he's set it up, so or let's say last year, prior to the 5th of April 22, he would have until January 23 to submit that tax return, including his new income. If he started his business after the 6th of April 22, then we're still in that same tax year, 22-23, and he would have to record that income of his new business up to April 23, and then that tax return would be due by January 24. Depending on when each self-employment started. If before 5th of April 22, then you need to complete a tax return for 21-22 due by January 23. And likewise, if it was after the 5th of April 22, then it would complete a tax return for 22-23 and it would be due by January 24. Always fun when you're throwing dates and numbers around like that, because it just sounds so confusing. But I do try and split it and take a breath between each one, so it can be followed a bit easier. Next question. Can I claim capital gains loss on a company that went into liquidation and is no longer listed on the London Stock Exchange? Yes, it may be of your interest to look at HMRC's website for negligible value claims. They have a list basically of companies that have been approved for the negligible value claim status, and effectively what that means is if you invested in a company which later went into liquidation and the value became of nil, then you can include that loss on your tax return, and provided that it meets certain criteria, you may actually be able to offset it against your other income from employment or self-employment. I would double check the company does meet that criteria though, and you can claim either by writing to HMRC or including the loss claim on your tax return. I do think we're getting towards the end of the questions now, so only a few more minutes. I believe that the webinar was meant to be 45 minutes, but I'll just quickly extend for those that can stay. I'd like to know how reporting students' loan in case when a person is resident in the UK but has foreign income as self-employed in overseas. So speaking again, it will depend on the residency status, but even if the income derives overseas and the UK resident, I would usually expect to see the income taxable on the SA 103 pages, which again, self-employed schedule. You would have to read the double tax treaty between the two countries and see what has been agreed for the treatment of the self-employed income, whether it is taxable in the contracting state when being resident, whether it's taxable in one basically country when you're resident of the other. So because you've told me that you're self-employed in a different country, you'd need to double check the tax treaty to see whether it's still taxable in that other country, and therefore you'd have to register for taxes there, or whether you've come here and therefore, because it's taxable on worldwide income, it would actually be taxable in the UK instead of that other country. Again, you may perhaps require some tax advice depending on what you can understand or make use of those double taxation treaties. They aren't in plain English, so 9 times out of 10, I would suggest either speaking to HMRC on the technical guidance line or getting in touch with a tax advisor. And I believe this is the final question. So this is about pricing on GoSimpleTax. We've got 2 subscription prices, one for one-off and one for recurring subscriptions. How long is the commitment for recurring subscriptions? So there's no minimum contract. If you want to make payment of the recurring subscription fee, which is obviously lower, then you can do. Submit your tax return and then cancel the next day. By all means, you can do that if you want. If you don't, then your recurring subscription renews on the 1st of April following payment, and this will continue indefinitely. We make it so clear when we ask you to sign up using the subscription package that it will renew and it will continue indefinitely. So unfortunately, we do not offer refunds if you forget to cancel. So I would definitely suggest, if you're one of the forgetful type, then looking at the one-off costs rather than recurring subscriptions. And obviously the one-off is a higher charge, but there is no renewal date. So yeah, it's completely down to personal preference. But if you choose the recurring subscription and you forget to cancel, then unfortunately you'll be stuck with another year of the license, even though you may not need it. Final question. Hi, I now live in full-time in Spain and I'm a resident. Do I need to do anything to let the tax office know? If you have any UK property that you rent out, then potentially you might have to complete an SA 105 and register for self-assessment. You would also complete the SA 109 residency schedule declaring your non-residency. If you don't have anything UK sourced and you now just live in Spain, I would advise calling HMRC and notifying them for future purposes, as well as updating your home address with them, just in case they send you any correspondence that you might miss now that you're in a different country. So thank you for joining us today. I'm just going to stick up another poll and say, did you find this webinar helpful? I can see that there's more people since last time. Hopefully I've answered all the questions that people are on here. I hope that nobody was on here and I didn't answer the question. If I did, then please go into the Q&A and let me know which one. And if we've got anybody who, oh, 1 second, there's some more questions on here. Right, okay. So what I'll do is I'll take note of those questions and I can answer them probably on a mail shot perhaps. So voting looks like it's finished. A couple of people have left. So just everyone knows, there we go. 95% of people did find this helpful, and unfortunately 4% did not. The person that was voted no, if you don't mind just sticking in the Q&A section why you didn't find it helpful, and we can basically have a look at that. I'm just going to have a quick skip through the answered questions here and see if I can answer any more. I'll run it to 5 o'clock for anyone that can stay on. So one question: I've started renting a property for about 1.5 years now. Can I now claim for a boiler replacement in full, as British Gas have stated in black and white the boiler is too old and suggested it needs replacing, even though they expected me to set up a maintenance contract when I first started renting a year and a half ago? If the boiler expense or the boiler replacement is a cost during the year, then yes. As it's only been a year and a half, you can always amend your previous tax return if need be to include the additional expense in there. Where can I read private responses? I'm using Chrome browser. Right, okay, that's been answered separately. I'm incorrect in saying that as a landlord, you can claim flat rate expenses of £1,000 against income, and this £1,000 can be claimed by my wife and myself against that perspective. If claiming this flat rate, I assume you can't claim other expenses. Right, yes. So just touching on this one now, that's basically called the property allowance. And if you have expenses as a joint owner of a property of less than £2,000, it's more beneficial to not claim any expenses and claim the property allowance each. So rather than just having £1,000, because it's jointly owned, you get £2,000. You would make a separate claim on each tax return, £1,000 and £1,000 for your shares, and yeah, you basically get the equivalent of £2,000 as a free expense against your rental income. If you have other expenses, repairs, mortgage interest relief, etc., you can't include them on your tax return. You're correct in saying that, yes. Talking of pensions, if I'm resident in France, where can I start a pension that is international? I've been delayed until now. I returned to the UK, but I now may not return, and I'm already 37 years old, so I would like to start a private pension. Do you have any recommendations? Unfortunately, I can't make any recommendations in terms of pension providers. You would have to speak to a financial advisor for that. Again, if you go onto GoSimpleTax and press the little red question mark, go to support and ask for a suggestion of a financial advisor. I'd be more than happy to point you in a direction, perhaps of a financial advisor for you. But unfortunately, I can't answer directly for pensions or setting up pensions or pension providers, unfortunately. Going down, can I do trust account? I believe I've answered that during the webinar. What if I use your software to record my income expenses? Is this not an allowable expense? As mentioned, I've answered that question on the webinar. No, because it's wholly and exclusively not for the purpose of the business. This is for you calculating your tax liability and then submit it to HMRC. That's nothing to do with your rental property business or your self-employed property business. Self-employed business, sorry. Then no, you unfortunately can't. Apologies on that. I don't know why I'm apologising on behalf of HMRC, but I'm just a nice person like that, eh? I missed most of this. Yeah, I believe that once we stop this, then the recording will become available to you by email, I believe. Hi, I did ask a question I submitted yesterday that was not answered during the call. I sold two properties in September 21 and filled capital gains tax return as required. How do I need to indicate the sale in the 21-22 tax return though? You would include that on the capital gains page, SA 108. It's basically the numbers that you've used on the capital gains tax returns. You would simply, provided that they're not changed, include them on your self-employed self-assessment. I'm getting all muddled up now that I've been talking constantly for 50 minutes. You would include them on your self-assessment tax return on the SA 108 schedule. There would be a box on there as well that says, have you reported this on a capital gains tax return? You click yes, and then stick the numbers in there that you've paid already, if you have paid any tax in relation to those. Hopefully that is enough for you. Who do I contact? Yeah, so basically, if you email support@GoSimpleTax.com, we'll be able to put you in the path of a tax advisor who can do some tax planning, or likewise, the person that wanted pension advice, that would be a financial advisor. And finally, last question, and then we'll knock it off. Apart from collecting receipts, what else should my son be doing to be ready for a tax return in 2024? Well, funnily enough, 2024 is a big year for tax. Making Tax Digital comes in. So they would need to keep all their records digitally, not even receipts, digital receipts. So they'll need to take pictures and upload them to a OneDrive, Google Drive, something of the sort that can be backed up, as well as having software which is compliant with MTD rules. GoSimpleTax will not. GoSimpleTax will have a MTD software. And it's not available at the moment, but it's currently in development, and we will be supporting the full compliance with MTD. If you're not too sure about what MTD is, then again, email support@gosimpleTax.com, and I will more than happily share slides that I've done in the past that are very informative in regards to MTD. I'll also send over some links. Thank you so much. You should do these more often. Thank you, Sonia. That's one of my clients in the past that I've done a tax review for. Hopefully found it helpful, and obviously email me if you've got any questions apart from this. So I believe that's pretty much everything. So hopefully everyone's enjoyed themselves today. I know it's hard to enjoy yourself when talking about tax, as it's more worrying, I'm sure. But yeah, I hope it's been informative and you've learned something new. And finally, anybody who does want to contact support with any further questions for myself, or whether they want any recommendations, referrals, etc., then support@GoSimpleTax.com. Perfect. So that's it from me and everyone at GoSimpleTax. I hope you've enjoyed it. Thank you.